Hello and welcome to lecture number 5. We'll be discussing short-term finance and planning. This comes from chapter 18 of your book. As we think about the role of corporate finance, the role especially of a CFO, we think of major decisions like whether or not to build a new plant or to acquire a new company. And those are extremely important decisions. They are very large, typically in dollar amounts, and have a big part to play in the growth of a company. But those decisions for an average company don't happen every day. So there are things that we look at and that we work through as a CFO that are a daily thing. And one of those has to do with short-term financing. So that's what we're going to discuss during this lecture. The key concepts and skills. First, we'll describe the operating and cash cycles and why they're important. This is also known as the cash conversion cycle. And this will be somewhat of a review from 3250 if you had my class in 3250. We will list the different types of short-term financial policy. We'll summarize the essentials of short-term financial planning, and we'll explain the sources and uses of cash on the balance sheet. So let's get started with sources and uses of cash. So we can look at the balance sheet, and this discussion is going to assume that you've got a basic understanding of what's on the balance sheet: assets, liabilities, and equity. So we're going to rearrange this a few different ways. Net working capital plus fixed assets equals long-term debt plus equity. So what is net working capital? Net working capital is just current assets minus current liabilities. So current assets minus current liabilities plus fixed assets equals long-term debt plus equity. We could move the current liabilities back over to this side and it would look very familiar. So that would just leave assets on this side, liabilities, both short and long-term, plus equity. That's the traditional. Well, as we're talking about net working capital during this lecture, it's important for us to understand the relationships here. So we've got net working capital. Like I mentioned, it's current assets minus current liabilities. So we could also write it out as net working capital equals cash plus other current assets. So that would be all current assets, cash plus other current assets minus current liabilities. We can get cash by itself. Cash equals long-term debt plus equity plus current liabilities minus minus current assets other than cash minus fixed assets. So these different rearrangements may help us understand a little bit more about the way the money moves around. So we've got sources and we've got uses. Sources is where are we getting the money from as a business? Uses, what are we using the money for? Sources and uses. So sources would include increasing long-term debt. That would mean we've increased long-term debt, which would maybe we've taken out a long-term loan, so we will have a source of cash from that loan. Equity, that means investors have given us money and we've given them shares of stock in the company. Or current liabilities, such as accounts payable. Whenever we don't pay for materials we have received, that is a source of cash. Are also decreasing current assets other than cash, or fixed assets. So as we convert inventory or accounts receivable into cash or fixed assets, let's say we had a truck we sold, we decrease these others, we'll increase our cash. Those are sources of cash. Uses would be decreasing long-term debt, so paying off debt, decreasing equity, maybe buying out other shareholders, or decreasing current liabilities, paying our accounts payable, for example, or increasing current assets. Let's say we're going to buy a truck. If we don't borrow for that truck, we would have to spend cash, so that'll reduce our cash. So increasing current assets other than cash, or fixed assets. Sorry, this would be a truck, fixed assets. Current assets would be things like inventory or accounts receivable. So when we affect these, it affects the cash in our business. You may or may not have heard the cliche, the saying, cash is king, and that is true. Without cash available, our businesses will not be able to run properly. So another little comment on net working capital. Net working capital is the amount that we need readily available on an ongoing basis to make sure that our doors stay open, we have inventory coming or available. So if you're a manufacturer and you run out of inventory, you have to shut down your plant. There's nothing you can manufacture with if you don't have inventory or materials and supplies. And so you need a certain amount on hand at all times. And so that's what net working capital will help us with. Okay, so now let's talk about the operating cycle. And this will be familiar from 3250 if you took my class. The operating cycle is the time between purchasing the inventory and collecting the cash from the sale of the inventory. And we'll look at a diagram on the next slide here. But again, it's the time between purchasing the inventory and collecting the cash from sale of the inventory. Our inventory period is the time required to purchase and sell the inventory. Our accounts receivable period is the time required to collect on credit sales. So our operating cycle is made up of our inventory period plus our accounts receivable period. That's what we call our operating cycle. The cash cycle is the amount of time we finance our inventory. And I'll show this again, like I mentioned on a diagram in the next slide. The difference between when we receive cash from the sale and when we have to pay for the inventory. So maybe we'll buy on credit, so we don't have to pay immediately. Maybe we'll sell on credit, so we don't receive the cash immediately. So depending on those things will depend on how much time we are financing our inventory. Accounts payable period is the time between purchase of inventory and the payment for that inventory. So when I was CFO of the electrical contracting firm, we would try and keep as little inventory as possible. So we would order, let's say it's copper wire for a job, the day before we need it on the job. So we'd have it going into the job, building a building, and then we would get an invoice. And that invoice wouldn't need to be paid maybe for 30 to 45 days. So while we already had the inventory, we were already using it in the job, we didn't have to pay for that inventory until several days later. So the cash cycle is our operating cycle minus accounts payable. In 3250, we also call this the cash conversion cycle. So it's the operating cycle minus accounts payable period. Okay, so here it is. This is figure 18.1 from your book. This is the cash flow timeline and the short-term operating activities of a typical manufacturing firm. Okay, so let's start at the top here. We are going to purchase inventory. So we purchase it. Let's assume that we purchased it on credit, meaning we didn't pay for it in cash. We're going to get an invoice and pay for it later. Okay, at some point, the inventory will be sold. So from the time it's purchased to the time it's sold is what we call the inventory period. And then from the time it's sold until the time we receive the cash, that's called our accounts receivable period. Okay, so these are what make up our operating cycle. It's the inventory period plus the accounts receivable period. Down here, we've got accounts payable period. So we've ordered the inventory, we've received it, but we don't pay for it until cash is paid, cash paid for inventory. So during this time, from the time we receive the inventory to the time that we pay for it, it sits in accounts payable. We owe money to the supplier for that. Then from the time it's paid until the time that we receive cash from the sale of that inventory, that's what we call the cash cycle. So another way of looking at this, or the actual formula, is inventory period plus the accounts receivable period minus the accounts payable period equals our cash conversions cycle. So the operating cycle is the period from inventory purchase until the receipt of cash. So from here to here is our operating cycle. The operating cycle may not include the time from placement of the order until arrival of the stock. The cash cycle is the period from when cash is paid out to when cash is received. So this flow of money can get us into trouble. If we're paying out and not receiving cash for a long time, what do we do in the meantime? How do we finance that? And so that's part of what we're going to be discussing in this lecture. So here's a little example that we will use. We've got inventory. So we're going to calculate our cash conversion cycle and our operating cycle. Inventory, we've got a beginning inventory. So at the start of the year, we had 200,000. At the end of the year, we had 300,000. Accounts receivable, at the beginning of the year, we had 160,000. End of the year, we had 200,000. Similar with accounts payable, 75,000 ended in 100,000. Our net sales were 1.15 million, and our costs of goods sold was 820,000. So why do we have beginning and ending? This is an important concept to understand when we're making decisions. Inventory, accounts receivable, and accounts payable are sitting on our balance sheet. And a balance sheet is nothing more than a snapshot in time. And unlike an income statement or a profit loss statement, the income statement shows a cumulative effect. So by the end of the year, we will be able to see everything that affected it over the entire course of the year. But the inventory and accounts receivable and accounts payable, as well as the other items on the balance sheet, it's just a snapshot in time, and it may not give us a good, accurate understanding. So when we're looking at sales and cost of goods sold, these add up over the months, but these don't. It's just whatever we have at the time. So what we typically do as we're working on these metrics, these ratios that we're using, we will take an average of the beginning and ending. So that'll give us an average for the year, and then we can use that, the average, in calculating with net sales and cost of goods sold as we look at the different items in the operating cycle. So let's start with the operating cycle. Using the information that we just saw on the previous slide, we're going to take our average inventory. So remember, it started at 200,000, ended at 300,000. So that's 500,000 divided by 2, so we can get the average. So our average inventory is 250,000. So using our cost of goods sold number now, we can calculate what is our inventory turnover period. Or sorry, inventory turnover. So it's 820,000 divided by our average inventory. So our inventory turns over about 3.28 times. Whether that's good or bad really would depend on the company and the industry, but this is what it is. 3.28 times we'll turn over the inventory, meaning we'll use it up 3.28 times over the course of the year. So the inventory period, we take 365 days, divide it by the inventory turnover, and we'll get an inventory period of 111 days. So when we purchase inventory in this company, it typically will sit in inventory for 111 days. We do the exact same thing to get our receivables period. This time we'll get the average receivables, which was 160 plus 200 divided by 2, so we can average it out. So 180,000 is our average receivables. Our receivables turnover is net sales divided by the average receivables. So our receivables turnover is 6.39 times during the year. So we'll collect our receivables over the year 6.39 times. The receivables period is just 365 days divided by our receivables turnover. And so we have 57 days to have to receive cash. So what this tells us is from the point of sales, from the time we sell our product, it takes 57 days on average for us to collect the money. And the inventory period, it takes 111 days for us to sell what was in our inventory. Okay, so our operating cycle is just inventory period plus receivables period. So 111 days plus 57 days. So operating cycle is 168 days. So what about our cash conversion cycle? So what we've got to do now is calculate the payables period, which we will then delete the payables period or subtract it from our operating cycle. So average payables, 87,500. Our payables turnover, we take cost of goods sold divided by average payable, gives us 9.37 times. To get the payables period, we take 365 days divided by the payables turnover, and we get 39 days. So what does this tell us? That our cash conversion cycle takes 168 minus 39, so 129 days. So that's from the time that we pay for the materials until the time that we receive cash for those sales. Okay, so let's go back just so you can see that. So cash cycle is from the point we paid for our inventory to the point that we receive cash for that. Okay. So we have to finance our inventory for 129 days. How do we do that? Well, we'll discuss that. If we want to reduce our financing needs, we need to look carefully at our receivables and inventory periods. They both seem extensive, 111 days, 57 days. If we could shorten those down, that would mean we would not have to finance our inventory for as long. What we'd want to do is compare our company to industry averages. And that would help us to understand, are we better than our industry? Are we worse than our industry? And if we're worse, then certainly we would want to look at that and see what we maybe could change so we don't have to finance our inventory for 129 days. Okay, so this leads us to our short-term financial policy. So we're going to look at different types of policy when we're looking at investments in current assets, so such as inventory. So the flexible or conservative policy has us maintaining a high ratio of current assets to sales. So in other words, we're going to keep a lot of cash, a lot of inventory on hand in order to be flexible. So if all of a sudden we get a big order coming in, we'll have what we need in order to fulfill that order. The problem is we've got a whole bunch of cash sitting around doing nothing. Restrictive or aggressive policy, we maintain a low ratio of current assets to sales, which means that we're a lot tighter, and if we get a big order coming in that we're not anticipating, we may not be able to fill it in a timely manner. So how do we finance our current assets? There's the flexible policy. So this has less short-term debt and more long-term debt. So this means we've got some cash that we've received using long-term debt. The restrictive policy, we're looking at just more short-term debt and less long-term debt. So lines of credit and other things, which would give us potentially the opportunity to do it quickly. And we'll talk about some pros and cons of that. Carrying versus shortage costs. Okay, so managing a short-term asset involves a trade-off between carrying costs and shortage costs. So a carrying cost, they increase with increased levels of current assets, the cost to store and finance the assets. So for instance, if it was inventory, we have to store it in a warehouse. We may have to have insurance on that warehouse. We may have to pay a warehouse manager to keep track of all the inventory we have in there. So there's a carrying cost of the short-term asset. Shortage cost is on the other side, decrease with increased levels of current asset. A shortage cost would be if we don't have it in stock, the inventory, and we get an order, well, we can't fill it. And so there's a cost there. We may lose the order. Trading or order costs, costs related to safety reserves, that is lost sales and customers and production stoppages. If you don't have inventory and you're running a manufacturing facility, you have to shut down your manufacturing facility because you don't have any inventory. So these costs have to be weighed. One's on one side, the other's on the other. So this would be our flexible policy where we have a lot of extras around just in case. This would be our restrictive policy where we're running very lean and mean, but if we get a shock, we won't have what we need. So another concept we want to look at is temporary versus permanent assets. So a temporary current asset are sales or required inventory buildup that may be seasonal. So we might need to have a seasonal increase in our current assets. Additional current assets are needed during the peak time. So maybe summer is the peak. And so the business needs to have more inventory or other current assets on hand. The level of current assets will decrease as sales occur. So we expect a certain level of sales up here, and as we approach that level of sales, our current assets level will start to be used up. And we'll show you this a diagram how that is done. So on the other hand, we've got permanent current assets. Firms generally need to carry a minimum level of current assets at all times. These assets are considered permanent because the level is constant, not because the assets aren't sold. So with inventory, maybe we'll always keep $500,000 worth of inventory in stock, but we're going to sell the old inventory and have new inventory replace it. So it's constantly rotating, but the amount or the level of inventory is what we call permanent. So here's a diagram of this. So our business might have these seasonal variations where they'll go up and they'll go down. In general, a healthy business, we expect a general growth in fixed assets and permanent current assets. So that line we expect to continue on as the business progresses, but we'll have seasonal variation right here. So the total asset requirement is our fixed plus this seasonal variation. And so you can see it goes up and it goes down over time. So how do we choose the best policy? Is it better to be flexible or restrictive? So there's some things to think about. Cash reserves. High cash reserves mean that firms will be less likely to experience financial distress and are better able to handle emergencies or take advantage of unexpected opportunities. So if you've got good cash reserves, then you'll be in a good position if you hit an emergency or have an unexpected opportunity. Cash and marketable securities. So we're talking about money markets, commercial paper, other very short-term investments. They earn a lower return and are zero NPV investments, meaning you're not going to make money on these. The cost of carrying it is the same as the money you would make, so they're zero NPV. Then we look at maturity hedging. This is where we try to match financing maturities with asset maturities. So we finance temporary current assets with short-term debt. we finance permanent current assets and fixed assets with long-term debt and equity. This maturity hedging, we do it with things like if you buy an automobile, um, the loan would be 5 years, and so a new car is new for 5 years. After that, it starts to become old and have potential issues. So in this case, if we need temporary current assets, so if we need temporary inventory, we should finance that with short-term debt in general. The long or permanent current assets, the level of permanent current assets that we need, and fixed assets, we should, in general, finance with long-term debt and equity. So interest rates do play a part in this decision. Short-term rates are normally lower than long-term rates, so it may be cheaper to finance with short-term debt. Firms can get into trouble, however, if rates increase quickly or if it begins to have difficulty making payments. They may not be able to refinance the short-term loans. Okay, so let's say we wanted to buy a factory, build a factory, and we borrowed short-term. So we had to pay it back within a year. And with the idea that we were going to refinance, every year we'll refinance. Well, what happens if interest rates jump up very quickly? We're very susceptible to changes in interest rates when we have short-term debt. The long-term debt, we lock in an interest rate, and so we don't have the same level of risk when it comes to interest rates. So we have to consider all these factors: cash reserves, maturity hedging, and interest rates, and determine a compromise policy that fits the needs of the firm. So this is what it would look like. You'll remember we had this seasonal variation going up and down. We had a very flexible policy, that's F, and that means we will always have on hand what we might need for emergencies or seasonal variations. Or we have our very restrictive policy, which means we are looking to have it on as little as possible, even realizing that we're going to have issues during the seasonal variation. So there's typically a compromise that businesses will make. So with a compromise policy, the firms keep a reserve of liquidity that it uses to initially finance seasonal variations. So as this curve starts to come up, we have the cash in hand, and we can see this variation begin. Short-term borrowing is then used when the reserve is exhausted. So once we pass this line, we're going to use short-term borrowing. We'll talk about different types of short-term borrowing here in just a second. Okay, so this amount right here, each of these peaks will need to borrow money, which will then be paid back in the troughs, which will give us sort of an average, that this compromise between the flexible and restrictive. So how do we plan ahead? How do we make these decisions? Well, first thing, we want to have a cash budget. We'll forecast using cash budget of cash inflows and outflows over the next short-term planning period. So when we say short-term, we typically are meaning a year or less. Our primary tool in short-term financial planning is the cash budget. It helps to determine when the firm should experience cash surpluses and when it will need to borrow to cover working capital requirements. It allows the company to plan ahead and begin the search for financing before the money is actually needed. So my first experience with the cash budget was when I was in my undergraduate degree. I was actually a music major, but considering changing to business, and so I was taking an accounting class. At the time, I was helping to manage a guitar shop in St. George, Utah. And I had an assignment in the accounting class to create a cash budget. And I used the information from the company that I was working for, the guitar shop, to project out the cash budget based on what we knew. And I was able to identify the 3 months down the road, we were going to run out of cash. We were going to need cash. The business was profitable, but we had made some purchases for some guitars and equipment that would need to be paid for, and we were going to run out of cash. So I went to the owner who had another business that was very profitable, and said, well, in 3 months' time, based on my calculations, on my cash budget, we're going to be short. We're going to be short about $30,000 that month. And he was extremely grateful because he was able to arrange some very favorable short-term financing for the money that we needed, and it really worked out well. But what if we had been forced to scramble? What if we hadn't budgeted for this cash crunch that we were coming across? We may not have been able to secure favorable financing. And so the money that we can save the company, the value that we can bring to the business by making these types of decisions can be significant. And these are more common decisions than capital budgeting decisions or capital structure decisions, which are big decisions but don't happen as often as mentioned previously. So let's go through an example. Please pay close attention. I'm going to throw a lot of information at you. If you need a pause to study the slide, please do. Okay, so our sample company, or example company, is Pet Treats Inc. And they specialize in gourmet pet treats, and they receive all income from sales. So sales estimates in the millions. So we've got it by quarter. So this cash budget is a quarterly cash budget. In real life, it doesn't necessarily have to be. It could be quarterly, it could be monthly. And depending on your business, I guess theoretically it could also be annually. So 500, 600, 650, and 800, and then 550 the following year. So that's a year's worth. Our accounts receivable is currently at 250. Our average collection period is 30 days. Accounts payable, we're going to purchase 50% of next quarter's sales. We have a beginning balance in Q1 of 125, and our accounts payable period is 45 days. And we'll talk about these days here in a little bit. So in Q1, we need to buy 50% of next quarter sales. Next quarter sales is 600, so half of that, 50%, would be 300. So we have to buy 300 worth of inventory in Q1, expecting sales in Q2. Okay. Other expenses include wages, taxes, and other expenses, which represent 30% of sales. Interest and dividend payments are $50 or $50 million, but I'll just say $50. A major capital expenditure is expected of $200 million in the second quarter. So these are the things that we know. And if you've been working in the business, these are not difficult to estimate. You'll get a general feel. Now you can have surprises. And so this is where you might want to consider sensitivity or scenario analysis, as we've discussed in previous lectures. But you should have a decent idea. So the initial cash balance is $80, and the company maintains a minimum balance of 50. So they always want to keep 50 million on hand. Okay, so given this information, we're going to now start to put together a cash budget. First, we're going to look at collections, cash collections. So this is the money coming in. So the average collection period is 30 days. So if we sell something on credit, it's in accounts receivable for about 30 days, then we get our cash. This implies that 2/3 of sales are collected in the quarter made. So what does that mean? So let's look at the first quarter of a year, January, February, March. If we sell something in January, we'll collect it in February, 30 days later. If we sell something in February, we're going to collect it in March, which is 30 days later. However, if we sell it in March, which is during the first quarter, we're not going to collect it until the following quarter. So we're only collecting 2/3 of this quarter's sales in the quarter. The remaining 1/3 are collected in the following quarter. So let's take a look at this. Remember, we had a beginning receivables of 250,000, sales of 500,000, million, 250 million, 500 million, cash collections of 583 million, and ending receivables of 167 million. And if you, and let me just escape here, if you look at the PowerPoint slide, you'll be able to see different calculations that we have over as we're calculating the cash budgets. So just wanted to show you that so you can look in the notes of the PowerPoint slide. Okay, let's see if we can keep this going. Okay, so now we've got our cash collections and our ending receivables based on the calculations that we have defined in the previous slide and in this slide. So these are the balances of our accounts receivable for each quarter. Now let's look at cash disbursements. So we have to pay on our accounts. So our accounts payable, we're going to pay 275, 313, 362, 338. And we got these numbers using the assumptions on that first slide of this example. Wages, taxes, and other expenses were 30%, you'll remember. We have interest and dividend payments of 50 million every quarter. So our total cash disbursements are estimated to be 475 million. You can see Q2, because we have an additional capital expenditure cash-wise, it'll increase that significantly. Q3 and Q4 are 607, 628 respectively. So our payables period is 45 days. So half of the purchases will be paid for each quarter, and the remaining will be paid for the following quarter. So our beginning payables was 125. So that's going to be paid in our first quarter. You'll remember sales in our second quarter were 600. So 50% of that will be purchased during Q1. And our payable period is 45 days. So only half of the purchases will be paid for each quarter. So the 300 million that we are buying for in preparation for sales in Q2, we're only going to pay half of that during this quarter. So half of 300 would be 150 million. So 150 plus 125 gives us 275. Okay, hopefully that makes sense. If not, please go back and re-listen to that. We have this 275 is the 125 that we're going to pay this quarter, plus 150 million, which we're going to end up paying this quarter for materials we purchased looking forward to Q2. Wages 150. So you can see our total cash disbursements. Oh, also interest and dividend payments are 50. Total, I've already gone through these bottom numbers, but you can see again 475, 743, 607, and 628. So we've got cash coming in, cash going out. Now we can put it all together into a net cash flow and cash balance. Total cash collections, total cash distributed. Our net cash inflow is 108 million based on these numbers. So we've paid out this much, we've received this much in cash. So we've got 108. Our beginning cash balance was 80. So the 108 plus the 80 gives us 188. That's our ending cash balance at the end of Q1. But we have to keep a minimum. We can't touch 50 million of it. We want to always make sure at a minimum we're going to have 50 million in there. So we've got a surplus sitting there of 138. But as you can see in Q2, remember we've got 200 million capital expenditure. That means our net cash inflow is minus. It's a net cash outflow of 176 million. So as we go through this, we had an ending cash balance of 188, you'll remember. So our ending cash balance is now the beginning cash balance of Q2. Subtract the net cash outflow, which means we have a positive cash balance, but it's less than the 50 million that we require to have as a minimum cash balance. That means we're going to have to finance 38 million there. So we've got a deficit of 38 million. You can see going on a deficit of 12 million, and then we've got a surplus of 110. So what do? We're going to have to borrow short term in order to take care of these Q2 and Q3. So one form of short-term borrowing is what we call unsecured loans. That means we haven't pledged any collateral. So a credit card typically is unsecured. The credit card company is loaning you money, but if you don't pay, they can't come and repossess your house or take your car, because that's not collateral for the loan. So lines of credit, committed versus non-committed lines of credit. So these would be committed are more formal and non-committed are less formal. There's revolving credit arrangements. So line of credit is typically renewed every year. Revolving credit arrangement might be renewed every 2 years or more. And then letters of credit, those are typically used internationally, where an international bank might write a letter saying that an international company that's trying to do business in a country that is not their domestic country, that they're good for it. Basically, the letter of credit from their local bank will say, yeah, we'll make sure that they're good for it. We'll guarantee them. Then we have secured loans. So secured loans means something is backing it. And in this case, we can back our loans with accounts receivable financing. So we could just assign our accounts receivable, meaning that if there is an issue with us being able to pay back the loan, at that point, the lender could then be assigned or receive the income from the accounts receivable. Factoring is a little different. Factoring allows us to sell our accounts receivable at a small discount. So we can sell it, and then the lender takes charge of the accounts receivable and will receive those payments as they come in. There's purchase order financing. This is a popular form of factoring used by small to mid-sized companies, and also inventory loans. You could do a blanket inventory lien, where if you don't pay back the loan, they can come and take your inventory, a trust receipt, or a field warehouse financing. The book does a good job of describing most of these. Also, there's commercial paper. Commercial paper really is only available to larger companies that have a credit rating. And I believe we've discussed credit ratings before, and credit rating will tell potential lenders, which are usually people who are looking to invest, whether or not the company is likely to be able to pay it back. And then, of course, trade credit. That's when our suppliers will let us take more time before we pay them for the supplies that we receive. Okay. One thing that will happen sometimes with some of the short-term financing is we may be required to have what is called a compensating balance. So I'm going to give you an example of a compensating balance now. We have a $500,000 line of credit with a 15% compensating balance requirement. So the quoted interest rate is 9%. We need to borrow $150,000 for inventory for 1 year. So what is a compensating balance? It is an amount that we're required to keep in a bank account. Their bank, the bank that we're borrowing from, will require us to keep a certain amount in a bank account. And that's what we call a compensating balance. So, and that cash has to sit there. So it's money that we can't use. It has to sit there as long as the line of credit is open and outstanding. So what we're trying to do, though, is we need to borrow $150,000 for inventory for 1 year. So how much do we need to borrow? So we need $150,000, but we have to keep a 15% balance in an account. So we have to borrow more than $150,000 so we can keep 15% in an account. So the way we can calculate this is we take $150,000 divided by 1 minus the 15%. gives us $176,471. So this is actually the amount that we're going to borrow. We're going to put the 15% in the bank, and the rest of it will come to us, the 150,000. So what interest rate are we effectively paying? How do we calculate that? Well, the interest paid, we're going to pay it on the full amount. So we've borrowed this 15% that sits in an account doing nothing. And so we've got 176,000 times the 9% interest rate. So our interest paid is 15,882. What is the effective rate? The effective rate, we're going to take this 15,000, which is the interest that we paid, and we're going to divide it by the money that we actually wanted to borrow or needed. So really we're paying not 9% because we didn't need that money. We didn't need the 26,471 that we put in a bank account. What we needed was just 150,000. So the real cost to us is going to be based off of, or the effective rate is going to be based off of the 150,000, which is what we needed. So it's really 10.59%. Okay, so that was compensating balance. Now let's discuss factoring again. Remember, factoring, we can actually sell our accounts receivable to a factor. But it's going to be at a discount. So we're not going to get 100% of the money. So if we have a certain amount in accounts receivable, we could sell 100% of it to the factor, but they're not going to give us the full 100% worth. So here's our example. Last year, your company had average accounts receivable of $2 million, credit sales of 24 million. You factor your receivables by discounting them 2%. What is the effective rate of interest? Let's go through this. First, we need to determine our receivables turnover. How many times, because if we're looking for an effective interest rate, we're going to think of it in times of an entire year. That's the way most interest rates are quoted. You know, if you're going to pay 5% on a car loan, that's 5% a year. But our receivables, most companies do not have receivables that are held more than just a month or two. So in this case, we need to figure out, well, how often do we turn over our receivables? Meaning, how often are we paid back from the people, from the customers we allow to buy on credit? So if our credit sales are 24 million and our average accounts receivable is 2 million, we can know that our receivables turnover is 12 times a year. So about every 30 days, we're getting paid back. So we can take this now, and to get the annual percentage rate, which is not the effective rate, we'll get there, the effective annual rate here in just a second. So we take our receivables turnover and we multiply it by 0.02, that's the 2% discount, divided by the remaining amount. So that would be 100% minus 2%, gives us 0.98%. So the annual percentage rate is 24.49%. That's the annual percentage rate. However, to get the effective annual rate, we've got to use this formula. We take the 1 plus the 0.02 divided by 0.98 to the 12th power minus 1. So really what we're really paying is 27.43%, which is significant. So as we get accounts receivable, we sell it to the factor with a 2% discount. So for every 30 days, we are paying 2%, but it's more than that because of the time value of money and compounding. We're actually paying an effective interest rate of 27%. That's very expensive financing, but companies do it all the time, especially when they have a significant need. Okay, so what we do then is we come up with a short-term financial plan. Once we have our expected cash inflows and outflows, our surplus and deficit, you'll recognize this. We can look at and create a short-term financial plan. So our beginning cash was 80 million. Our net cash inflow in Q1 was 108 million. So our ending cash balance was 188. Remember, we have to keep 50 million in as our minimum cash balance, which means we'll have a surplus of 138. Okay, so with that surplus, what will we do? Well, what we can do is we can invest it short term for that month or that quarter. And what we're seeing here is we make $1 million in interest over that time, but then we have to sell that short-term investment and use it in our second quarter. You'll remember our second quarter, we had a net cash inflow of a negative 170, or net cash outflow of 176 million. So we're going to have short-term borrowing of 38 in Q2, which we'll pay interest on. Remember, that'll give us an ending cash balance of 50, which is our minimum. So we had to borrow 38 in order to keep an ending cash balance of 50, and so we have no surplus. So our change in short-term debt, we had to borrow 38 million. So that's where we're at. That's our balance, is 38 million. We went from 0 to 38 million. We go to the next month, our net cash inflow is 26 million, so we can pay down part of this. However, we have to pay interest, so we can only, our net here, so we have 26 million inflow. We had to pay $1 million in interest from the loan from the previous quarter, which leaves us with 25 million. And so our ending cash balance is going to be 50. So we'll still have 25 million outstanding. But you can see here our beginning cash, or beginning short-term debt for Q3 was 38 million. That was our ending we're able to pay down 25 million, which leaves us with a short-term debt balance of 13 million. So you can see that. So then it takes us to Q4. We've got a significant cash inflow. We're going to pay back our short-term borrowing, which will leave us with an ending cash balance of 159. We have to keep a minimum of 50 on hand, which will leave us 109. And so you can see we've paid back our debt here. So that is the short-term financial plan. So we'll, as a business, try and project what's going to happen in the future, and that is not always accurate, because things can be unexpected. But in a typical average year, most businesses will have a decent idea of what's going to happen, and so they plan ahead. They know they're going to have to borrow in Q2 and Q3, and be able to pay it back in Q4. Okay, so that is the end of the lecture. I'd like you to, on your own, go through the quick quiz. First question, how do you compute the operating cycle and the cash cycle? Second, what are the differences between a flexible short-term financing policy and a restrictive one? What are the pros and cons of each? What are the key components of a cash budget? And what are the major forms of short-term borrowing? So when I was CFO, just to kind of wrap things up, I spent quite a bit of my time dealing with credit, dealing with short-term financing, making sure that we had just the right amount of cash in the bank, investing in short-term investments when we had excess cash. And it was something that took a lot more time than whether or not we should acquire that other company, which only came around once every couple of years. So one other thing to think about is an ethics issue. I just want you to think about this. A large retailer such as Walmart possesses power over smaller suppliers. Walmart's huge, and suppliers want to be in Walmart. They know they can sell a lot of their supplies if they can just be in Walmart. So in theory, Walmart could force these suppliers to sell on payment terms that were well beyond a typical industry norm. So Walmart could say, well, yeah, you can sell through us, but we're only going to pay you 90 days from the time you give us your supplies. And that may be way outside the typical industry norm. So how would this impact Walmart's cash cycle? How would this impact the supplier's cash cycle? Are there any ethical issues involved in such a practice? So I want you to think about that. Lastly, I'm not going to read this to you. I want you to do the comprehensive problem. On the PowerPoint slide that's posted on Canvas, in the notes portion of the PowerPoint slide, you'll see the calculation and how to work it out. If you have any questions, that concludes this lecture on short-term financing and planning. Please feel free to give me a call during my office hours or shoot me an email. I'm happy to schedule an appointment if you need it. Thank you very much.